on the headlines, and I think one of the stuff that I want to cover for today's session is about the treasury bonds. So, so when we talk about the US dollar, a lot of eyes are on the treasury bond situation. But of course, before we do that, let's take a quick peek on what's happening on the Forex Factory calendar. So let me just share the screen, and here we go. All right. Okay, so what's up? What's up coming next on the Forex calendar? We have a bunch of, next week is a little bit of a heavy news week. So you can see a lot of great news coming up. We have on Tuesday, CPI figures, all right? On Wednesday, we have GDP from the UK side. We have more economic, we have FOMC on the Thursday, federal funds rates on Thursday, all right? So this will be interesting to keep an eye on. And of course, we have a couple of other, I think the Euro monetary policy statement would be interesting to just put an ear to. Australian unemployment rate is over there. So next week's a little bit news heavy, which does give us an opportunity to find to find nice pops of currency pushers, right? While we don't really trade the news, we can actually position ourselves to see whether we can take advantage of the volatility that's in the market. So one of the key I would say sentiment that's been going around in the market right now is about the bonds, right? US interest rate is currently at 5.25%. There is talks of targets hitting 6% in the near to medium future. This is an article I'd like to share with you guys over here. All right, so this is an article that came out about maybe sometime earlier last week. It talks about the Treasury's 1 trillion debt, that could threaten the market. Essentially, if you can just go Google, this article, and it's on the Wall Street Journal. So basically, the summary of this article is it really talks about what does it mean for US Treasury yields to have so much of debt in the market. So this is where the US Treasury yields are at right now. Short-term, 3-month short-term bonds, about 5.25. This is where the Fed funds rate is kind of pegged at. 2-year notes are about 4.5%. There is a little bit of a jump as comparatively to the last couple of months. Treasury Department is rapidly trying to replenish its so-called coffers, and it is about while it is kind of interesting to have such high bond prices, what does it mean for interest rates as a whole in the US market, right? Because at 5.25%, 6% interest rates, if you translate it, if you pass on the cost down to consumers, it would mean that it is more expensive to take a housing loan. It is more expensive to take a car loan. It is more expensive for businesses to borrow money to expand their business, right? And that is what inflation has done, is made things more expensive. And what the government is trying to do is trying to cool down the economy by increasing interest rates so that people don't spend as much. Therefore, they can't borrow as much money to expand their businesses. There's less transactions going on because it's too expensive to, but however, it is a double-edged sword, right? Because things are already so expensive, and what the government is actually doing is making it even harder for those at the lower tier of the income band to kind of survive, right? And that is why their focus is really to push down inflation, but increasing interest rate is actually a double-edged sword. So who benefits in this world of high interest rates is the bond market. If we look at the US 10-year yields, let's go and look at a couple of the US bond yields according to their years, just to see what it means to have that interest rate disparity. So over here, I have the 10-year yields. All right, 10-year yields touched a 3.81%. This is a daily time frame sometime last week, and it seems to be holding at this area. If we look at the US 5-year yields, all right, you can see a very similar price pattern. All right, it's also, this is 10-year, this is 5-year. You can see that I'm just toggling both right now, and you can see that the yields have a very similar translation, because that's how bond markets move, right? They move in accordance to the 2-year, 5-year, 10-year yields, and everything just kind of adjusts together. So the higher interest rates are right now, it means that the 10-year bond interest rates will be higher as well, just that it's not as high as the short-term rate. So short-term interest rates will always be a little bit higher as opposed to the yields in terms of the long term, because of the fluctuation. So we have US 10 over here, and this is I actually have a US 2-year over here. You can see the patterns are really pretty similar. US 2-year yields at 4.6%. US 5-year yields is about slightly below 3.9 to 4%. US 10-year yields is about 3.8, 3.7%. So the moment the interest band starts changing, all the bond market will start changing. So the question we have now is, in the face of surmounting debt, will the US consider or even think about either stop increasing interest rates, or will they try to pop down interest rates? So this is the dilemma we have right now, right? Because on one hand, if we look at trading economics, interest rate has gone down quite a fair, healthy chunk, right? It was, at one point, the last couple of months, let me just click into this. So the last couple of months, it has gone from, if we look at October is about 8.27.7%. The highest in July 2022 was 9.1%. So technically, it's almost half gone, right? We are almost slightly less than half, 4.9%. Okay, so the Fed now has an option. It's either they hold the interest rates for a while more to allow allow the inflation to continue to squeeze in, and because the effect is a lagged effect, right? Meaning that there will be some delay on whatever's happening on the screen. So the 4.9% is not because of the current 5.25% interest rate, it's because of the previous move. So inflation is usually lagged in terms of the data that comes out. So the question is, how much is the government willing to overshoot or undershoot to achieve their target? Because it's already on the downward decline. The government now has an option to either hold interest rates or to consider lowering interest rates a little bit to start moving it back down. And this is what is going to be interesting, because when you start to lower interest rates, what's going to be happening? It's, in a way that is quantitative easing, right? So in a way, by lowering interest rates, we're going to make money a bit more accessible, meaning that the US dollar should start to weaken in terms of, because now it's cheaper to borrow in USD, a lowering of interest rate theoretically is supposed to allow the USD to weaken. But then the government will have to think about, do they want the USD to weaken? So when we look at the US 10-year rates now, I think there is going to be at least a small probability there that in potential interest rates will either hold for the next couple of weeks, and towards the end of the year, instead of popping up to 6%, there is a good chance that they might go down to 5%. Now, why do I say that? It's because it's a double-edged sword. The longer they keep a high interest rates, the more trouble they'll be in. It's just the nature of where the money is going right now, right? So they have increased interest rates so much right now. The longer they keep it at 5.25, even at 6%, it means that the more trouble is going to be coming back in the back end. So it's a matter of how long they want to drag it out. All right. So there is that small probability. Hopefully, if they kind of figure it out, that this inflation is lagging, they can't tolerate a 4.9%, 4% inflation rate, then I would think there is a good chance that they will just say, okay, we're not changing interest rates for a while, or we might even pop it back down to 5%. Now, I don't believe they will pop it back down. I think there's a higher probability they'll just hold firm, because the moment interest rate starts to drop, it would mean that there will be consequent drops. They're not just going to drop down and then increase it later and then drop and go up. So traditionally, how the US market tends to manage the interest rates, they don't fluctuate, right? They make a decision, then they start to slowly go towards a certain direction. They don't go up and down one month to the other. So what it means for us as traders is, while the USD might be slightly sideways for the next couple of weeks, the moment the US starts to drop interest rates, is going to be a very, very cool trend coming up. A downward trend is probably coming up for the USD. Now, traditionally, I'm a dollar bull, meaning that I prefer to be on the side of the dollar strength. But if interest rates do come down, all right, I think there will be a chance for the USD to start to mediate towards a certain level. If we look at the USD across the board in the other currencies, I'm going to use the index for this just to see the bigger picture, right? If we look at the USD index over here, all right, over here, it has already come off a fair bit. Okay, despite having a high inflation, it has really come off a little bit because of the sentiment, because of the commodity market, and it is now at a point where I would say that it is kind of reaching. This is 2020, very near pre-COVID area. So it's $99. So I'm looking at the 99 let me just clean this up a little bit. I'm looking at the 99 region, 99. Okay. Then I'm just going to delete this one. Okay, so if you look at 99, the index, the dollar index at 99, the reason why I'm picking 99 because we are differentiating between pre-COVID, post-COVID, right? So pre-COVID was somewhere around the 2020, 2019 area where currencies were starting to fluctuate. And then before that, you can see the norm is around this area. It's around the 96 to 99 level prior to the COVID period when the economy was, just getting its legs. So if we translate it over to a little bit more here, for the USD to kind of mediate back to the norm, if inflation starts getting back to normal, if interest rates start meandering back to normal, then I think the journey for the USD towards a midline is quite possible. But for that to happen, we need the US to kind of give us an indication of when potentially will they be comfortable and confident to start to reduce interest rates. And then we should possibly be able to target the US dollars towards this area. All right, I mean, there is a ways to go down, right? So I think it's really hard for me to be a dollar bull, even though I want to be, all right, because the interest rates is a very sideways market right now, precisely because of, basically the debt just means that they have such a high debt means they got to pay very high interest because, that's what high interest rate means, right? So it's just a matter of, if you're buying a house at 6% interest rates comparatively to 10 years back when you're buying it at 0.25% interest rates, that was what US dollar interest rates are, something has got to give. So what will give? I'm pretty sure, a decision will have to be made soon. There must be some reason why they took so long to decide on raising the debt ceiling. There must be some discussions behind that we're not privy to, but I do believe a slightly clearer picture will come out in the weeks to come as we see the US start to position themselves to, are they going to hold interest rates or are they going to go down? Because the debt ceiling is a very fresh reminder that their debt is a lot, right? It's just purely they're in a lot of debt. They have just hit the ceiling. Do you want to aggravate the problem by continuing to increase interest rates, or are they going to hold firm and try to figure out other ways to cool off the economy, other ways to cool off inflation, other ways to allow the economy to cycle back to a medium, back to the medium? And that is what I'll be looking for in the next couple of weeks. A close eye on the USD, but more towards opportunities for the short side. Not so much because I think US dollar is weak, but because I think of the potential sentiment that is coming out from the USD. I think as governments try to position their bond yields, we should see a little bit more USD being flooded back into the market as governments do their bond rebalancing. All right, so that's where I'm looking at right now. So we'll see what comes up. There is the I think next week there is the FOMC statement. I think the CPI, the CPI would give us an indication, right, to see whether the CPI improves or doesn't improve. It will tell us where it goes. Daryl, you commented when the stock market crashed, maybe it will help bring the USD down. When the stock market crashed, a lot of things will be very volatile. And in fact, I do sometimes feel that if the stock market crash, in fact, the USD will strengthen because the money has to flood to somewhere, right? If you don't want to hold stocks, you have to hold it in cash, or you have to squeeze your money in bonds. So there's no right or wrong. It just which one is stronger? Fear is stronger, FOMO is stronger, or greed is stronger. And that is what is driving the currency market in the world. It's not about, it's very little about fundamentals these days. It's really more about sentiment. Which is stronger, greed, fear, or FOMO, right? And that is something that we have to remember as we trade the forex markets, that while the fundamentals are telling us one thing, let's not forget in this day and age and technology, fear, greed, and FOMO can move markets. All right. So with that, I'll end off this session of mine, and let's see what the technician has to say. Lloyd probably will give us a slightly clearer picture on the technical side, where we ignore the news, we ignore the noise, and let's just maybe the indexes will help us in that. Over to you, Lloyd.
Hey, thank you, Alexis. Hey, before I actually shift on, just from my side, fundamentally, I think the stock market and USD will actually fall in the next 1 month, simply because the Fed has already approved their debt ceilings, right? So that means US has already approved their debt ceilings. That means the Feds are going to issue a lot of bonds in the market, and that's going to suck up liquidity in the market. Now, liquidity is more or less fixed. That means asset transfer from some one way or another, it has to go into the bonds. So that means to me, I would think it's a good time to cash out your stock if it's rising, because they have to sell their stocks. I mean, to bring out the cash and use the cash to buy the bonds. Yeah, and the same would actually be happen to US dollars. Yeah, so short term, and my short term is probably about 1 month. Yeah, I think things will drop.
Yeah, that's good to know. I mean, that's exactly how I have the sensing I have now. It's I'm a dollar bull, but I cannot bull the dollar now. It just feels a bit wrong right now.
Yeah, then for the next 1 month, just short it lah. It's
Short it
okay.
lah, yeah. When it comes up, just short.
Yeah, as long as it fits your strategy, can no problem.
Yeah. And that's the thing, guys. I love it when Lloyd says as long as it fits your strategy. That's always the caveat.
Isn't that always the case?
Yeah.
All right, so with that, I'll take over now. On my side, it's actually quite clear cut as to what to trade for the next 2-3 weeks, because I don't really have on my charts. I have two obviously strong and two obviously weak, and anything that's in between, I will just ignore. So I always love this kind of scenario because it's very clear cut to me. Now, what's obviously strong on my chart is actually the British pound. I can see that I'm on a weekly chart for the British index. Prices rise, higher low, higher high, higher low, bounce off a very nice horizontal in the past. Again, this is the British index, and I'm on the weekly chart. So, and you can see that this is a very, very nice bullish bar that has a very beautiful close. As such, clear cut, I'm going to long the British pound against any other thing. Yeah, and this is as good as a strong signal. Now, the only thing that prevents me from really going a 10% trade, really, don't go in a 10% trade, but it's just this high. Yeah, but bear in mind that I'm on a weekly chart. So that means the H4 and H1 traders, you have a lot of headroom to go. Yeah, the D1 trader might be better if you have a take profit one somewhere. Yeah, but otherwise H1 easily 2:1, 3:1. You can actually get for it just for the British pound. And I do mean, if it isn't clear to you, I mean long. I don't mean short. All right. Now the next on my list is actually the Swiss. And then magically in 10-second time, I think my chart should load. If it doesn't, let's just chit chat. I can see Alexis blinking. That means I'm still online. Otherwise, my chart is still not loading, and I don't know how to go on for. My trading view has jammed. Yeah, but anyway, while it is still loading the Swiss chart, let me go to the British pound. I'm actually weak. My analysis tells me that I'll just skip forward, that I will be shorting, I'll be long pound and Swiss. Okay, pound and Swiss, I will long it, and CAD and dollar, I will short it. Yeah. If the chart loads later, I will show you why. So as such, I have a very good chance to actually long pound dollar. Poundy dollar. Yep. So you can see pound, this is, any of you who trades the chart pattern, this will simply means a cup, and then I'm just waiting for a handle, or otherwise, just to make things simple, price break a structure, and I'm just waiting for a break and retest, and then another break and retest, and these two other plays that I would love to trade. So this is a very, very clear cut, simple move. Yeah, I'm just waiting for a confirmation. Confirmation comes in the form of price action that will bounce off. Yeah, not exactly be neatly this area, but as long as it gives me another high low, I'll be happy to trade it. All right, so that's the British pound, pound dollar, right? Pound dollar long. Then, as always, I'm on the H4 chart for trading. If I do get in a position here, my final take profit will be at this level. So easily give me 3:1 or 4:1 for such trades. Right. Now, next that I'll be looking for to trade. So as I mentioned that according to my analysis, I'm short DXY and CXY. So that means it's the dollar index and Canadian index. I'm going to trade the pound CAD long also. Yeah. So the H4, you can see that, wait, let me jump to the dollar D1 chart. Yeah, you can see the D1 for pound CAD. This is a very nice level. That price is just bouncing off. You can see that as on the D1, very, very nice bullish bar. Yeah, not a very clear trend that we can trade, but this is a very clear level that we can trade off. So when we go down to H4, things sort of become clearer for us. When this scenario happens, So this one requires a bit of patience. Right, so you can see that price has formed a double bottom, a higher low. Right, double bottom, higher low. Yeah, I don't feel particularly comfortable trading. Yeah, so I'm just waiting for next higher low. This is where I will be keen to jump in. Yeah, once price goes there, a safe, probably a 1:1 or 2:1, I'll take a partial profit off this level. Then I will let the trade run. Where do I need to? I'll just probably let it run to here. Easily a 5 or 6:1 if it happens. Right, so pound dollar and pound cat just, as always, waiting for a break and retest, and then we'll be good to go. Now, has my Swiss load? My Swiss has not load. If I change to this chart, will it load? There it. Yeah. So why I'm actually long the Swiss? Simply because on the weekly chart for the Swiss index, very nice up, down, up, down. Look, this is for a trend trader. This is always what we are looking out for. You can see that price has bounced off a very, very nice $110. Yep. So I'm prepared to actually bear in mind this is a weekly chart. All right. So if you're trading on the H1 and H4, we do have a wide latitude to trade into. Right. And these are very clear-cut levels that I am ready to trade. Now, as for the Kiwi index, this is less clear to me as to where price will go. I can only speculate that price on the Kiwi, no doubt, long term is on a downtrend. And price just reached last week. It just reached a very nice level. So we can say that it's a break and retest. I can speculate that it's going short. Right. So like I say, the term that I'm using is I can speculate. It's just not as clear to me compared to pound and Swiss. Yeah. So that's why the Kiwi index I put in the middle. Anything that's in the middle, that means I'm actually not too sure. Same for the Euro index. I'm also not too sure. Now, again, on the long term, we can see that price is rising, right? But really, is it bouncing off anything? Is it that bullish? I'm not too sure because this is a level that I actually can't really just ignore. Yeah. So I rather trade the easy stuff, not things that actually complicates my mind. Now the yen again, I'm not very sure where it wants to go, and in fact, this is a double inside bar on the weekly chart. It's not. If it actually retraces back up to this level and giving me a rejection, I'll be happy to trade it short. If it has not, I'll prefer to actually wait it out. Yeah. Might be 1 or 2 more weeks before it gives me a clear signal that I can actually short it. Yeah. Otherwise, double inside bar on a weekly chart is just waiting for some sort of breakout. Yeah, I don't wish to be caught in the wrong direction. I'll just wait it out. Now, Aussie index, long-term downtrend, clear cut. But you can see the last 2 weeks is very bullish. What's happening, I don't really know. In fact, this is really a classic spring. You can see that price wobbles, goes down, spring up. Yeah, some may trade it as a Wyckoff spring. I personally don't trade it. I'll just wait for a strong rejection of this level. Maybe 1 more week to wait for a high test bar or even a very bullish bar, and I'll be happy to trade it low. Short of giving a very clear-cut signal, I'll just wait it out. I'm not going to touch the Aussie index. Now, next is the Canadian index. Now, this is the reason why I prefer to trade short, right? Long pound, long Swiss, short cat, short dollar is because, look, this is a range. It has been since, what, last year, ranging. Price might reach up 1 more week, might or might not, but this is just a clear-cut range. And when it's a clear-cut range, price has rejected several times here at this region. And it just tells me to actually go low. Simple as that. And then the last on my list will actually be the dollar index. So again, dollar index, where we can see that price has already gone lower. But on the not so wide picture, this is again a range and it's at the extreme. So you can see that price has rejected last week and continues bearish momentum. Hence, I'm keen to actually go short. So as such, just now I've shared pound cats and pound dollar. Let's have a look at cat Swiss. Right, I'm going to short cat. So on the 4-hour chart, for cat Swiss, I'm just waiting for a, some of you would say it's a very classic head and shoulders. Trading here will be dangerous, but will lead to higher reward. Now, if you want to wait for the full pattern to form, then this will be a break and retest of the head and shoulder. This will be a clearer place for us to trade, right? So 1 is high risk, 2 is low risk, right? So depend on your stability. Now, for me personally, I will trade at 1. If on Monday or Tuesday I see a bearish bar comes in, I will jump in. It fits my trading plan. And then the last, which is slightly complicated to trade for me, is a dollar Swiss. Again, I think Swiss was strengthened, dollar will weaken. Now, why I say this is slightly complicated is before that, we can see a dollar is on an uptrend, H4, right? I'm on the H4 chart, and there's a very, very nice looking trend line. So price has break the trend line, and in fact, it's very nice horizontal level here. That's indicated by the box. Now, price may just reach back up for a final grab at liquidity at this area, which still constitute a lower high. Then this will actually be a very, very nice place for me to trade all the way down to this level. Yeah, this will be a very, very nice risk to reward trade. Or it might also happen at its current level. You can see that this is a what you call indecision bar happening at a very nice horizontal level. So this is at itself, price what is happening now is a very classic break and retest. So again, Monday or Tuesday, there's a very good chance of it happening. Yeah, but if it happens and it and a stop loss occur, this is scenario 1, then I'll wait for scenario 2 for it to actually go higher before I attempt again. Otherwise, I'll just wait for here. The scenario 3 will be a safe place to trade. All right, by then that will be a second lower high already. That will be a confirmed downtrend for me to trade dollar Swiss short. Again, my final position will be, final take profit will be somewhere here. Yeah, prepare to let the trade run. Yeah. So when the trend comes, and sometimes when it's clear cut, some patience is needed. But when it happens, I would say don't be afraid, just pull the trigger and wait for the profits. Yeah, just now I went through the Aussie and Kiwi index. You have all the currency index. We don't have SGD index. Yeah, but just that for now, the Aussie and Kiwi doesn't give me a very clear scenario as to where I should be trading it. Yeah. So usually when it's not a clear scenario for me, I'll just automatically assume that it's ranging. I don't really particularly like to trade range. Yeah. I do trade at the extreme ranges. That's where a new trend will form. Yeah. So I take my analysis from the weekly chart and I go down to H4. That's how I do my analysis. So with that, Alexis, anything to add on for you? I think I'm actually supporting your analysis, right, for dollar.
Yes, definitely. So I'm actually happy that, we have a similar analysis for that. And then, it helps when the fundamentals and technicals kind of align. It has a bit more, I will definitely have be a bit more aggressive. Once the strategy sets up for a short, definitely will be a bit more aggressive down there.
All right. So with that, thank you for joining us, and we'll see you. I believe both of us will see you 1 month later.